Good afternoon, everyone. A few people just making their way to seats, but let me welcome you to the Charlotte branch of the Federal Reserve Bank of Richmond and our first district dialogues of 2025. We've done a couple of these before in the branch where we had some programming in Richmond, and then we followed it up here. It's the first time we've done it where the event is contained here. So we've got the audience here, and then welcome those of you online as well. We've got a pretty substantial audience online. So we're glad you can be here. It's April 1st. I was gonna come up and make an elaborate prank and say something like, we lost a couple of our panelists to illness, and so we're gonna have to change topic to dental hygiene or something like that. And at our team meeting this morning, everybody's like, yeah, you should do that. But I don't have the wherewithal to pull it off. So we'll play it straight today on April 1st. So we're gonna do a couple of things. Do we start off with a Slido? Oh, wait, so let me put this up. That's important. So you've got the QR code here. We're gonna ask you a couple of Slido questions throughout the course of the day or the afternoon. And we're gonna start with just a little bit on the national economy and then get into our main topic on exploring the importance of the housing market. And I'm going to leave this up for a little so you all can get this because we want audience participation. Lots of cameras. That's good. And iPads. I'll just wait another minute because I still see people trying to get it. Oh, did you see the question? Which emoji represents how you feel about the economy right now? You've got 5 choices. One that is clearly winning. I gotta make sure I know which one okay, there we go. It's easier for me to turn around and look. All right, we'll give another minute here, but I don't think anything's gonna catch up to the surprise emoji. I don't know emojis very well. That one to the left of it, what do we call that one? That's the sad emoji? Okay. Okay, the sad emoji and the crying emoji, I guess, are close in second, but the wide-eyed emojis clearly got it. Okay. Well, that comports. We're going to spend just a minute or two talking about the U.S. economy and a brief overview. And the wide-eyed emoji is probably about right. Trying to figure out how the U.S. economy is performing right now is a little difficult. It's like driving in the fog. We certainly came into 2025 with an economy that had some momentum, but it's a little bit harder to decipher where we are now for a couple of reasons. The first one, if you can see these slides, there's the danger of widescreen format is you can put 2 slides on at once. These are both related to the consumer. And there's an open question about whether consumer spending is slowing in the moment because of uncertainty, right? Policy uncertainty certainly looms out there for both individuals and businesses. And when you look at the data is confusing. January was a very cold month. Heck, South Carolina had a couple of different snowstorms. When's the last time that happened, right? And so it affected spending. So if you can't see the charts very clearly, there's a little box for each. The one on the left's retail sales, which is a big chunk of consumer spending, but not all of it. The one on the right is personal income expenditures and actually disposable income. The takeaway from these is January was down across the board, right, because of weather. February rebounded, but not so strongly. And so there's some concern about where the consumer is right now. We could actually have a very strong March. I don't know if it's come out, but sometime here imminently we'll get auto sales for the month of March. And the early guess was those might be quite strong as consumers rush out to buy cars ahead of any tariffs that might drive up the price of cars, right? So the data is confusing. And then, of course, sentiment, consumers are saying that they're a little bit worried about, as you all did with the wide eye emoji, a little concerned about what may happen down the road. And that uncertainty could cause consumers to sit on the sidelines. The hard part about this is seeing this in real time. And I'll just note, what we do out of this branch and out of every Federal Reserve office is we have some people that are engaging with the business community and other members of the community to try and get that real-time read. And that comes out, we get that far faster than we get the actual data report. So it's an important thing that happens all across the Federal Reserve footprint. Other things, labor markets look pretty good though as we sit here today. Again, you've got two slides here. The one on the left is the unemployment rate. 4.1%, a little bit higher than it was a year ago, but still very low in terms of the business cycle. And this one has a forecast that comes from members of the Federal Open Market Committee. They met a couple of weeks ago, and 4 times a year, and March is one of these, they put out a forecast for a few variables. The unemployment rate's one. The little orange diamonds are there. That's the median forecast, and there are some bands around that. Nobody's forecasting a sharp rise in the unemployment rate at this point. The one on the right is labor flows. And one thing we have seen over the last couple of years is the labor market has gone from being one where employers would say their number one concern is finding workers to being much more in balance. And you can see that that blue line on that chart is the job openings rate. And coming out of COVID, that went to a historical high for this series. It's now back to sort of a normal level. The red line below that is the hires rate. And that's actually come down quite a bit and is fairly low relative to the historical context for that series. So but there aren't a lot of firings happening as well. So we're in a low hire, low fire environment, but so far the labor market looks like it's okay. Something to watch. The other thing we care about, of course, is inflation. This is our preferred measure of inflation that it's called the Personal Consumption Expenditures Price Index. Again, coming out of COVID because of supply chain issues primarily, you can see this measure went up to about 7%. It's pulled back to about 2.5%, and it's been a little stubborn at 2.5%. You can get a forecast there. I'll just note these forecasts are for end of year, year-over-year growth in inflation. Look at the second one over for the end of 26. The median forecast is really close to our 2% target, but the bands around it are a little wider than maybe normal and mostly to the upside, right? So there's some risk to the upside that you're getting reported from members of the Federal Open Market Committee. And then I won't spend much time on this. This is the famous dot plot that also comes from members of the Federal Open Market Committee. What I do want to note, and you've got the one from December, which was the one before the one we got in March. The ones for this year, the median dot is just below 4%. That would be a 50 basis points of cuts in our policy rate by the end of the year. Notice to the far right of each of those panels, there's something that's called the longer run. That's individuals' members' estimates of a long run neutral rate for our policy rate. And so where we are now and where the median dot is for the end of the year is still at the high end of that, suggesting that policy is a little bit on the tight side, meaning if you were to use the analogy of driving a car, still tapping the brakes, right? Not hitting the accelerator, and that's where we are there. So a little bit by background and level setting, why is the Fed interested in the housing market? Monetary policy is what we're known for. It's one of the important functions of the Federal Reserve. I would note there are other things we do, and that's true in this building as well, right? You all came through security to get in this building. That's not because we're trying to protect our employees as much as we love them. It's because down in the basement, there's quite a large vault with quite a large amount of cash in it. And so we have to take some security measures, right? So payment services is an important thing we do, and we do out of this branch. And the other thing is we supervise banks. And I think actually by numbers, the largest number of people in this branch are people in our bank supervision area, right? A couple of big banks down the road and some other functions that support that. But our topic tonight really more squarely fits with monetary policy. Things we do primarily with short-term interest rate to try and influence economic activity, particularly Congress has given us, we call it the dual mandate. There's three listed here: maximum employment and price stability, which we have explicitly said we have this 2% target over the medium term. That third one, moderate long-term interest rates, if we do our job on number two, we're probably making the best contribution we can to number three, moderate long-term interest rates. And housing's part of the economy, right? In fact, if you look at gross domestic product and break it down, building of homes accounts for about 4% of GDP, and then housing services, paying rent or owner's equivalent rent, paying your utilities, insurance, all those things that go with a house. Together, those two things make up 16% of GDP, make up a larger share of consumer spending. Consumer spending is about 70% of GDP, so that 12% becomes something more like 17, 18% when you do that. So it's a pretty substantial portion of GDP. It has employment, it has price implications if there are changes in pricing of these housing services. So we definitely care about it for that reason. Let's level set just briefly on what's going on with the housing market. This is the median sales price for the US. This is average across the country. And as you might imagine, home prices tend to go higher over time, right? We went through a period in the late teens before COVID where housing prices sort of leveled out. Coming out of COVID, the shorthand joke is in COVID, we shut down parts of the economy. Lots of people were working at home and they found out that they didn't like their house, and in some cases they didn't like their roommate. So housing demand became a thing coming out of COVID, and that's when you see the median price for a home in the US go up by almost a third over a fairly short period of time, and since then it's more leveled out. So that's where home prices are. Interestingly, despite the rise in home prices, there are not a lot of homes on the market for sale. And this is largely more to do with existing homes. So the blue here is existing homes. The green is new homes in inventory for sale. The new home inventory is actually a larger share of homes for sale than it's been in a long time because there's just not been a lot of existing homes. I think that's starting to change. I saw an article this morning. This was in the Triangle Business Journal. They had an article on homes for sale, and it said that inventory is 30% higher now than it was a year ago. So we're starting to see more homes come on the market, but there's been a pretty short supply over the last number of years. And as well, we've also seen construction costs go up quite a bit. This is construction costs year-over-year change. You can see the spike again coming out of COVID. That rate of increase has slowed down a bit, but there was a period there. We heard about certain components that you might put in a house, whether it's electrical or others, sourced overseas that were hard for builders to get a hold of. Obviously, when you have that kind of shortage, price goes up. There may be some other implications from tariffs on things like lumber and other inputs. So this may see an uptick again in the future. And of course, interest rates matter for buying a home. And so here you see three interest rates. One in orange is our policy rate. It's an overnight rate. It's a very short-term rate. And the other two you see in blue are the 10-year Treasury, and the green is the 30-year mortgage rate. They all tend to move together, but as you look at this chart, it should stand out that the green and blue move very closely together, right? But not as closely to the orange. And this is particularly relevant when you get to the far right side of that chart. Since September, the Federal Reserve has lowered its policy rate by a full percentage point, and the 10-year Treasury and the 30-year mortgage have not come down essentially at all over that same time frame, right? So mortgage rates haven't moved a lot despite the overnight rate coming down to some degree. And that has a bearing on affordability. And this chart probably needs a little bit of explanation. HUD uses as a guideline that homeowners should spend no more than 30% of their income on housing. Obviously, it allow budget room for other things. So you see there, the vertical axis is percent. At 30%, you see that orange line for that guideline. And what we are charting here for the US in green and for Charlotte in blue is the percentage of income that a median family would need to spend to buy a median priced home in that market, right? Median being the 50th percentile. A couple of things to notice about this chart. For the duration of the chart, the Charlotte area has a better affordability than the nation as a whole. But if you look at the chart going left to right, affordability was improved as we came out of the Great Recession. Lots of things contributed to that. Affordability was pretty good for a while, and then coming out of COVID and about the time mortgage rates went up, affordability becomes much more of an issue. I would also note that over these last few years as well, the gap between the US and the Charlotte MSA has diminished, right? So Charlotte's not as affordable relative to the nation as had been the case in the past. And then finally, I'll just note this, the home ownership rate for the US, it's highlighted there in orange, but you see home ownership rates for a lot of different countries across the world. Not quite 2/3 of US households are homeowners, and it's important that we recognize that the housing market is not just single family, right? You can rent, so the rest of households are renting either in a multifamily or single family setting, mostly multifamily. And the US's homeownership rate, we're actually a little bit below the European Union average, but we're above some large countries like Germany and France, right? Just for some context there. And so with that, I will call up our panelists who are going to come up, and then we'll have a discussion, and there will be time for Q&A. Those of you online, you can submit it online as well, and we'll go to some of those eventually. But I'll invite all my panelists to come up, and then we'll have them introduce themselves once they're up here.
Everybody smile. That was so encouraging.
Okay, well, did we have a Slido question? Did we keep that in, Kevin? No, okay, just making sure I didn't miss something. So we sort of got the audience reaction to the economy overall, but what I want to do is we'll start at the far end with Gray and have you all introduce yourself a little bit, and then just say a word or two about how you're seeing the housing market today. We'll get to what you think might happen in the future, but for now, let's just focus on what things are as we sit here.
Well, my name is Gray Gordon. I've been a research economist at the Richmond Fed for about 7 years. Most of my research work focuses on credit-related things. So I started with consumer credit, moved into some housing, and I also have work on sovereign debt. And I wrote 2 short economic briefs on housing. One of them is on the back table there about that I just finished last week about forecasting where we're going with house prices. So that might be of interest. And then another one on mortgage spreads. I'm also working on mortgage lock-in, like people in their homes with really low interest rates. And I think we're in a really exceptional period in housing. It's a very interesting time. You'd have to go back to the 70s to get a period where you had such great lock-in, and there we didn't have great data. So now we're in an interesting time where we have this unusual situation and a lot better data to look at the situation. So there you go.
Good afternoon. I'm Dion Nelson. I am president and CEO of Laurel Street Residential. We are a mixed income housing developer headquartered here in Charlotte, developing across the Southeast. I founded the firm 14 years ago, and today we have a development portfolio of about 6,000 units between Richmond and Atlanta. We also launched LSA Management, where we operate property management for our units a couple of years ago. I would say our perspective is the market is just strained. So I think if I had to vote, I didn't do the vote, I'd have the big bubble eyes too. But the reality is in the work that we do, we just have to push through. And so we are continuing to do the work. Deals are continuing to move forward. Frankly, nothing has really come to an automatic freeze. But it is a very uncomfortable operating environment.
My name is Yun-Chan Chu. I'm a professor of real estate and finance and also the director of Children's Klein Center for Real Estate at UNC Charlotte. And so I do research in real estate, housing, mortgages, and our center also releases every year the State of Charlotte Housing Report. So my comments about housing were mostly based on the data I know about Charlotte. So the housing market now is kind of very different than 2-3 years ago. It's not that crazy, but there's still lots of uncertainty going forward. Thank you.
Hi, good afternoon. I'm Carrie Cook. I am our Vice President of Community Development at the Federal Reserve Bank of Richmond. I also serve as the Community Affairs Officer for the bank. And it's my pleasure to work with and lead our community development team across the 5th District. We really focus on economic and community conditions with low and moderate income households and communities. And as we focus on those conditions, what we see and what I would describe with the current housing market is that it's just really tight. You all know affordability is a challenge because of rising costs, but we continue to see low and moderate income communities having to make trade-offs. I just looked at some recent data on evictions that are up in this area and across the district. And we're seeing that whether it's for rent or for ownership, low and moderate income households, because of pandemic era assistance expiring, because of rising input costs and other costs, because of things like utilities and taxes and insurance. If you're on the ownership side, there is a greater strain on low and moderate income households throughout the 5th District.
Yeah, and that's a good setup for our first broad question is, I think if I were to summarize, it's an extraordinary time for the housing market. There's a lot of dissatisfaction. I certainly have had conversations where people spend a lot of time talking about the lack of affordability at all levels within the housing market. What are the biggest constraints to improving the housing market along the dimensions people care about? And Dr. Chu, I think we'll start with you on that, and others can jump in.
So I've been probably saying this for as many years as we have been doing the State of Charlotte Housing Report. So there has been a lot of underbuilding since the Great Recession for whatever reason. And in the Charlotte area alone, we are looking at cumulative about 30 to 40,000 units kind of deficit compared to the number of households, because Charlotte is growing and people are still moving to this area. So, and affordability is a huge concern, as Matt, the graph just showed. So our research shows that for 2024, if you want to afford a median priced house in Charlotte area, guess what income you would have? $150,000 of gross household income, so that you do not spend more than 30% of your gross income on housing related expense. Of course, several reasons are contributing to this, right? House prices increase a lot. I mean, Charlotte area 2020, 2021, those 2 COVID years, price probably increased more than 45%. And the interest rate is super high. And as the graph show, interest rate is not gonna go down anytime soon. And actually the long-term view is really good, because a lot of us like only remember like the interest rate since, let's say, 2012, where like a lot of us probably had like mortgage interest rate 3.5, or even less than 3. But that's not the norm. I don't expect that to be like the case probably not in my lifetime. So we're probably gonna live through like at least 5.5, and 6% for many, many years to come. So that's not gonna change. So, and on the other side, the supply side is still gonna be pretty tight. So you guys probably all, if you're in Charlotte, you see a lot of construction in recent 2 or 3 years, but that has significantly slowed down, right? Because of the tightened monetary policy. So we're probably gonna see a lot less of that delivery, especially in the next 2-3 years. So although house price growth has significantly decreased in 2024, so our data shows that from February 2024 to February 2025, house price growth rate was about like 2%. Relative to a year ago, it was like 6-7%. But I don't think that will continue unless something dramatic happens. For example, if if a recession actually happens, then things could change. So there's a lot of restrictions on the supply side. So in the Charlotte area, there's like infrastructure constraints. You guys probably heard about sewage capacity, and then zoning regulations, and then of course there's always NIMBYism that people do not want anything built like close to their home. All those things are contributing to like lower the prices of housing in general. Thank you.
Yeah, a couple of context points, and then I'll let anybody riff off of that if they want. So short about 30,000 units. That's roughly the order of magnitude of how many new households show up here in a year, right? So maybe right about a year's worth of supply. And your 150,000 to afford a median price home is, I'm going to forget the numbers, Carrie might know them. I want to say that's roughly twice the area median income. Yeah. Yeah. What about different components of this? Gray, you had noted the mortgage lock-in piece in particular.
Yeah, so there's very interesting distinctions to be made between like what's constraining short run versus what's constraining housing in the long run. In the short run, I mean, housing supply is basically fixed. How many properties can be brought to market by developers is just a drop in the bucket compared to the volume of houses sold. Like we saw in Matt's chart, if you look at existing homes sales versus new home sales, the new homes are a small fraction, even now with existing home sales collapsing. So all that sort of inventory of existing homes is affected by lock-in. So that's one constraint here. But then in the long run, what really determines is like zoning. What's the availability of land? How much does it cost to construct homes? So, you know, NIMBYism might have like a negative connotation. I mean, it's a totally sort of rational response in the sense of you want your own house to have a high price, right? You don't want a big development going up right next to you and depressing your house price. So that's like a hard thing to overcome. But that's one factor constraining supply.
Well, I'm going to address the NIMBY question first. Comment first. I think in many respects, the NIMBY concern is the question is it a rational concern? Is there real data that suggests that density really changes the value of existing homes? But I understand that the reaction that many people in the community is to resist the density. The problem is we have you're caught on both sides. If we resist the density and the growth and the production of units, you are further exacerbating the short supply, which is further exacerbating the affordability crisis. And so if we as a broader community really are committed to addressing the affordability issue, it is about production. And it's not just the production literally of affordable housing, it's the production of housing, right? We're short housing. The affordable housing component, which is where we play, and we play more on the multifamily side than on the single family side, is more challenged, because not only do we have those same challenges with respect to finding land and the density we seek to develop being challenged and the market receiving that effort, but we also are trying to deliver a market rate quality unit or development and rent it to households that make less than market rate. So that is what I call the math problem, right? That math doesn't work. And so it only works if you have subsidy. And subsidy can come in a number of different forms, but in markets like we face today, that subsidy is even more and more constrained. Even though Charlotte raised its housing bond in the last election cycle, the reality is the cost of that same housing is substantially greater. Those gaps are greater. The ask that we will make of the city of Charlotte will be greater. Therefore, in some ways limiting the actual number of units that you see come to market. We're kind of the dog chasing the bus, right? And I'm not sure we're catching it, right? We're panting, running behind it, but we're not catching the bus. And so even though we've done more, and I applaud the local efforts and in many communities that are trying to find ways to do more, I'm not sure we're there. I'm trying to be not super negative.
It's a great point, Deanna, and I'll build on that. I mean, seeing the city and watching the Housing Trust Fund go to 50 million to 100 million, it helps. But again, there's still that subsidy gap. And so what we're seeing across the district is communities coming together with solutions that provide more incentives to meet the gap, that have zoning that supports more opportunities to bring more housing online. We're seeing, just following on the point around water sewage, I mean, we've got urban areas in our district, we've got suburban areas, we've got rural areas and small towns. And so when you look at land and land availability, it may be available, but it may not be suitable for development. And so you have topography issues, water sewer infrastructure issues, other issues that create an impediment to bringing the housing online. And so, you know, you've got a couple of different factors that are really constraining the availability and the opportunity to bring more housing as a whole into the marketplace. And that subsequently, when you talk about entry into the market, if people can't move up in their housing, then how do you get into the market in the first place, right? And so where do those opportunities start to avail themselves? And that's what we're seeing. People are locked into rates, as Gray mentioned, not trading up. And therefore, we're also seeing the bottleneck happen where people are just trying to get into the market for their first home for ownership, but also for rent. We're seeing the costs continue to rise, and that has an impact on a domino effect on a number of different factors.
Yeah, thank you. Deanna, I probably want to come back to you because there are other cost factors I want to make sure we get a read on with this audience as well. There's labor costs and having available labor. There's cost of materials. We've been talking around the land cost itself. Can you comment on the current state of play there and kind of have where your thinking is around the various inputs to building housing?
So all are up significantly if we compare it to pre-COVID. So, and it kind of happened in various stages. So I think when we first came out of COVID, we were facing supply chain issues. And because we couldn't get product or the supply of certain products, lumber, et cetera, was substantially strained, the cost of those materials went up pretty dramatically. Since then, that has stabilized. That's better. But then we get hit with the next thing, which was interest rate increases. And as interest rates go up, you know, all development has debt on it as well. And so just like when you're trying to start a new development, if the interest rate goes from 5 to 7, the underwriting of that development probably doesn't work anymore. So what we experienced as developers was having to re-underwrite deals over and over and over again in order to figure out how to make the math problem work. And in some cases that meant we needed more subsidy. We've had to go back to our local government and local partners to figure out how to fill those gaps in order to move those developments forward. I would also say that there's an indirect effect that I have observed, which is just sheer efficiency. Everything takes longer, right? Whether it is an approval to get zoning or building permits, you name it, it takes longer today, whether it's rational or not, it takes longer today than it did 5 years ago. When we first launched Laurel Street in 2014, we built 100 units in Gastonia in 10 months. You cannot do that today. You ask any general contractor to give you a schedule to develop 100 units, I promise you the starting schedule is going to at least say 18 months. But time is money. And so in that time, you're exposed to all kinds of other variabilities. So whether that is changes in the labor market and labor shortages, things that can extend the project in terms of time, in terms of change orders for cost, et cetera. And of course, today we're having all the conversations. Well, what about tariffs? And what about this? And what about that? So my message to my team is go faster, right? Let's go. Because we can't predict what the uncertainty that we have to deal with to try to move a development forward is basically costing the whole development market and development community the ability to deliver. And so Dr. Chu's point that we will probably see continued strain on supply is very real. The math problem still doesn't work, and time and uncertainty is not our friend.
So I think we spent a fair amount of time describing the issue and particularly on the supply side. Let's turn and talk about how do you make some progress in fixing that? What would help? I'll take any first comers who want to take a shot at. I'll just note, we've been talking about the difficulties in bringing more supply onto the market, would suggest that the solutions are on the supply side. And the reason I mention that is you get in these discussions and things like down payment assistance and those sorts of things crop up that are on the demand side. I don't know, Carrie, maybe you can comment on that piece before we go into the supply side solutions.
Well, sure. I mean, down payment assistance has just become more critical than ever for folks to get into the market and from a home ownership perspective. But when you think about strategies to support bringing more housing to the market and housing that's affordable for your local communities, I would say two things. One is that we've seen examples across the district where you've got to make housing a part of your economic development strategy. For a long time, communities have had housing sitting over here and then other economic development, recruitment of jobs, other things in a community in a separate, in a siloed sort of area, right? But moving forward, having housing as a part of a coordinated economic development strategy, listening to local residents, understanding the needs, understanding area median income, and then understanding what developers could feasibly do in that area is critically important. And when I say what developers could do, I mean, can you get innovative? We've seen projects in like Hagerstown, Maryland, and other areas where they have brought online manufactured housing that looks way different than the manufactured housing that you'd be thinking about from 50 years ago. It looks comparable to site-built homes, and they've got beautiful front porches and high-end finishes, and they're actually within a price point that local residents who are in the workforce can afford when you talk about that area median income. So I would really say two strategies in addition to what Matt mentioned around, you know, incentives to get folks into their first home. One, have a coordinated approach to your housing strategy that is a part of your broader economic development strategy. And two, think about other ways to bring housing online to meet your local workforce needs.
I'm gonna say two things about potential solutions. One is about the NIMBYism. Gray was saying NIMBYism is a rational response to the problem, but there is something that we need to consider. It's probably bigger kind of consequences of NIMBYism. For example, if the house prices are really high, where are the school teachers gonna live? Where are the firefighters gonna live? Where are the policemen gonna live? So yes, when you have NIMBYism, you hope that your house prices will go up. That will benefit you. But that will hurt a lot of the people that provide a critical service to the community, to you. So think more broadly when you are trying to go protest against whatever development that's happening around your neighborhood. Because I've seen my neighbors did that like 1 or 2 years ago. So that's one thing. The other thing is related to, like Dion was saying, the approval process. It's kind of amazing that things are slowing down with like technology is just growing tremendously. Think about ChatGPT, how that can like speed up whatever you are doing. There is actually a lot of potential for adopting technology in this world. For example, I'm not sure if you guys see the real UDO of a Charlotte new UDO. It's like this thick. Anybody, if you want to do it, go through everything. I don't know how long that will take. I'm not sure if anybody has actually gone through that thing. But if you feed that thing into an AI and then let AI go through all those like documents pretty quickly, if it satisfy everything, go through. That should be able to, at least technically, should be able to speed up a lot of the process. I think this is not so difficult to implement. Of course, other than like human factors, if there's lots of NIMBYism, and there's lots of talk about like the rural areas, for example, for the Charlotte, like surrounding towns, the NIMBYism is actually a bigger problem there. Because if you think about a town with 10,000, 20,000 people, everybody is in the backyard. Any building you want to do will be in their backyard. So that's also very difficult as well. Okay, so I think there's more, I mean, the NIMBYism part, I think there is an education component of it. People needs to understand that, for example, in the city of Charlotte, I love Charlotte. I moved here in 2018. But if housing becomes unaffordable, then the growth will have to stop at some point, which I don't think we want that to happen. But if we want that growth to happen, then we have to compromise. We will see more density. We have to accommodate more density so that housing become more affordable that can accommodate the future growth of Charlotte. I think there is a lot of the education piece behind it. Thank you.
Yes, or else the housing gets pushed further and further out. And then my bumper sticker is once you mess up housing policy, you end up talking about transportation. And then that maybe that's our next topic. And quick reference, UDO, Unified Development Ordinance, isn't that correct? Okay.
I would add, I'm going to pick up on something Carrie said about innovation. I think if you really want to talk future, I think the challenge is the suggestions I'm about to make aren't things that are going to happen or be available to us tomorrow. But over time, in addition to looking at other ways of construction, I would think on the multifamily side, one of the things that's been talked about a lot in the affordable housing space is modular construction. We have done it and used it to some degree, meaning we've had general contractors bring in panels, like a single wall on trucks and stand up the panels and, you know, like they're doing a Lego building as opposed to putting together the framing of the building with all 2x4s, right? But in other markets, I've seen them literally being in boxes with units completely done. Stack them on top, connect the dots, and deliver a building. But those are some construction efficiencies that I think would benefit our market. I think there are challenges to it. Where are those factories? How far are they from our local market? Because if you've got to truck those boxes and those panels from too far a distance, then that becomes inefficient again. But there are some ways to think about how do we build in our community, and are there ways that we could be more efficient and more cost effective? I also think on the financing side, we have to think about new tools. We've done a great job in local markets thinking about bonds for housing, the Housing Trust Fund, et cetera. Where we've gotten stumped a bit is because of state legislature limitations around things like tax abatement. And inclusionary zoning and things of that nature that really drives the inclusion of affordability into typical developments. Or when I say tax abatement, recognizing that we could waive some fees or waive some property tax costs. So I don't know if people realize that affordable housing in North Carolina pays property taxes in full. Right? We get assessed differently because we're assessed based on the income of the property and the economics of the property rather than just the physical construction of the property, but it still is a big cost baked into the affordability model of housing today. And so while tax abatement in North Carolina is not a legal choice today, you can do a tax grant. So we could get creative if we wanted to solve those problems. And lastly, I would suggest thinking about bringing other investors to the market. So we typically talk about affordability around tax credit development, et cetera, where those developers are tax credit investors. But I think we've also seen in recent years, as we raised the 50 million of the private sector capital that went into the Charlotte Housing Opportunity Investment Fund, and as those teams have looked to raise more capital in subsequent years, that there are some impact investors in the world that I think are open to bringing capital into the housing market differently than maybe we did many years ago. It would require us to structure financing differently. But we need to be open to those options. We need to be courting those investors, bringing them to our communities, and really thinking about how can we make the math problem work differently. But I think there are options available to us if we continue to work at it.
Can I add, Deanna, it's a great point. I was literally giving a speech in Hilton Head, South Carolina last week, who has just a number of affordability challenges for a number of reasons, and their workforce is far away from where the hospitality and other job market opportunities are. So they're trying to figure out the housing piece. And I had at least 3 folks who are in capital asset management and other various funds come up to me and say, how do we figure out how to get involved in housing and make a difference in housing? I had a follow-up message on LinkedIn from one gentleman who was very persistent about how do I get my firm engaged in solving some community problems? So there is capital out there that's thinking about.
You can give them my phone number.
Okay. Call Beyond. End of sentence. Yes. No, I mean, there are absolutely folks thinking about this, and my speech was primarily focused on philanthropy and the role that philanthropy can play in helping to catalyze different community issues. But you had a number of different stakeholders in the room, and I think that's a really powerful thing. When you have various stakeholders in the room who are all engaged, it goes back to a point I mentioned earlier about having a coordinated approach to housing and having multiple stakeholders at the table to be intentional about housing as a part of your economic development strategy.
Your Hilton Head reference is interesting. I can think of at least one employer down there that's also engaged in employer-provided housing, which is also an option. Gray, you want to bring us home in this section?
Yes. So in terms of like I mean, lots of things can happen in the short run that affect the price of housing affordability. But in the long run, housing affordability, I think, as far as theory goes, has to be determined by sort of 2 factors. One is the price of land, and one is the replacement cost of housing or the construction cost of housing. Okay, so how do you reduce, or how do you increase housing affordability in the long run? Well, one is you reduce the price of land. So how do you reduce the price of land? You increase the supply. So if you make development easier, if you increase the places you can build, or if you expand infrastructure to make it easier to get into the city from further out, that will depress the price of land. How do you reduce the price of construction? Well, I think that's what some of the panelists were saying. Like if you go to modular construction or the prefab construction, these are ways where it's more productive to produce the same unit using those technologies. One challenge is that when you go historically back, construction as a sector is just not a high productivity growth sector traditionally. And because of that, the price of construction just remains perpetually high, and that's reflected in something called Baumol cost disease, where low productivity sectors just have higher prices. So it is a challenge, but there are some ways to make headway.
There you have your term for your next cocktail party, Baumol cost disease. Okay, so I'm done asking questions. We'll take some questions from the audience. That includes the audience here in the room, and those of us that are listening online, you can submit them online as well. We have some mic runners, so I know we've got one over on my left and another one further on my right. So why don't we go right here in the room?
Good afternoon. My name is Faith Triggs, and I'm with Habitat Charlotte Region. So just in the sense of maybe just being politically correct and so no one loses their job, when you look at the political climate that we are in and the administrative policies that are being made, what would be the why for why we should move in a different direction? Because there's so much uncertainty. A lot of policies are devastating, specifically to nonprofits. And so how do we get back on track with the why? Because it's all about money and greed. So what is the why? And anybody can answer that. I'm sure you all have an opinion on it.
I'll jump in and I'm gonna keep my job, but I'm also gonna say that the why is central for myself and for our team. Our community development team is focused on being the heart and the hard work in communities. And so when you think about the why, Nat showed a slide earlier that referred to being housing cost burden. And housing cost burden is defined as spending more than 30% of your household income on housing expenses. There's data from, so first let me put this into context. 3.6 million households in the 5th district are housing cost burden. So roughly 29% of households are spending more than 30% of their income on housing expenses. Hold that data point. The second piece, when you think about the context of that, and when you think about the way in which that plays out in communities, there's not only the initial housing cost burden, 30% piece, but there's also severely rent burden. So there are households that are spending more than 50% of their household income on housing expenses. When you're looking at that and why we should be looking at that is how do you address that issue without folks having to make a sacrifice to downgrade their quality of housing and the subsequent impact or effects that has on them and their families. Mental impacts, physical impacts, the development of children impacts. So when you want to talk about a why, when you want to talk about, why there is a need to make sure we expand housing opportunities and particularly opportunities for workforce and affordable housing, there's really a statistic that we can hold that tells us that what we currently have is putting a lot of families in a position to make difficult choices every day. And we want to support economic mobility in communities so that they can contribute to their local economy.
Yeah, the question is, and I'm not sure we can answer it here because we're not them. What's the why for leadership in this discussion? I think we'll probably have to, unfortunately, stick to speaking for our own perspectives. Anyone else want to weigh in on that one?
There is one, it just, economists get fascinated by different things. There is one sort of interesting policy that the president has proposed, which is expanding like federal land or selling federal land off. So if you're trying to reduce or increase housing affordability, putting a huge chunk of land on the market actually could do something significant.
We had another question over here on the right.
Carlos Gladden, 360 Music. My question is, even with the current, we all know it's a marketplace from housing, economic development, business spending. How does the market rate for the housing affect the small businesses? Because we all know that if a consumer can't spend money, they can spend in small businesses, they can keep jobs. How does it actually impact the growth of how many jobs that we create, that those can afford to actually spend the money? Because I do know those that want to start businesses, we all know the average entrepreneur makes up to $3,000 a year. If you've been in the game long, you make $100,000, $250,000 plus a year in revenue. How does that actually impact the marketplace on spending money with the overall marketplace where they can afford to live and pay bills? Because we know if they stop spending money, that means also employment goes down and jobs go down, and we also end up having what's called layoffs. How does it impact and how do we grow that and sustain that over time?
Yeah, so I'm always fascinated by places like New York City, right, where it's just housing is so expensive, and how do workers just service workers afford to live there? And part of it is they live really far out and they pay a lot of cost to do that. But part of it is also the wages have to adjust to make that feasible. So if you don't do anything else and the housing prices just go up, then sort of local wages have to go up to to support that, which, yeah, it drives up costs for small businesses, but also the reason probably house prices went up was like some richer people moved there and they spend more. So there's a balance, and prices do a lot of work there. Price of output and price of labor.
I'll actually make a comment here. I think about this a lot for communities like Charlotte, that their growth occurs with a lot of professional service jobs that require college graduates to move into the region, right? But then all those people that move in, they all shop, they all do those other things, and you need a different workforce to fill those jobs. And to Gray's point, over time, you would think if labor for those kinds of roles gets harder to find, there would have to be some sort of wage adjustment. Or your growth model gets cut off altogether because people can't have the quality of life because they don't have the services that they think the community should have. I'm gonna,
Or your growth gets cut off because companies won't choose to come to Charlotte.
that's right.
Right? If as companies evaluate where they want to have their headquarters, where they want to build a new plant, where they want to have certain operations, it is the diligence of that company to evaluate whether or not they can attract the talent that they need to do those jobs in terms of, does the market offer the skilled labor that they need for those particular jobs, but also can those employees afford to live there? And if they're not seeing yes and yes, I think you will see fewer jobs coming into the market and ultimately fewer people moving here. People move here because it's attractive on many levels. In theory, affordability in, our Sunbelt environment, there are lots of pluses to the Charlotte market, but effectively, they also believe they can get a job.
We'll take one more in the room and then I'll see if we have any online.
Thanks. Matt, thanks for convening this. Dion and Dr. Chu, I want to ask you this question. It's a little bit about NIMBY. How do we in Charlotte and other high growth areas, how do we be compassionate, certainly, but fiscally responsible when it comes to legacy neighborhoods that have so much growth going on around them that it happens in their neighborhood and it becomes a very difficult math to make work for families that grew up in neighborhoods and can't afford the homes anymore. But how do you work through that, Dion, and especially given what you've done, and what's a responsible way forward and considerations around that dialogue?
I mean, I think we have to look at the programs that are made available to legacy residents or legacy homeowners. I know, for example, the city has a program around helping to manage property taxes for some of our seniors in neighborhoods that are changing or gentrifying pretty dramatically. I would also argue that we also have to be very conscious about bringing affordability into communities along with the growth. In many cases, we've been very reactive rather than proactive about the affordable component. So those legacy residents they can't afford to stay in the existing home and there's nowhere for them to go that's in the same neighborhood. But if we could create opportunities for people to stay in the same community and stay in the same neighborhood because we were intentionally planning it differently. I'll use as an example, River District. When Crescent got approved for their zoning in the River District, they made a commitment about a percentage of affordable housing, and the affordable units that we're building for Crescent is going to come online along with the first buildings of market rate housing. In theory, trying to create a twinning, if you will, where people can afford to stay along with the growth and the market rate development and all of the mixed use development, et cetera. But I think we should be more intentional about that. And that's maybe where the innovation can come back in. What other programs could we create to create a balance for people who might be struggling to stay in those communities because their property values are going up and things are changing so dramatically?
I just want to add, so there is certain market segment that the private sector itself or the market rate will not be able to serve. We have to acknowledge that and then think about how, as Dion was saying, for example, private-public partnership or other kind of more of government programs that will have to kick in. Otherwise, the market, if you are, let's say, MI below, let's say 60%, it's very difficult for the market to serve that segment. Subsidy will have to come in for whatever legacy neighborhoods or whatever that part of the market.
Can I just add very quickly to that question? In communities, particularly legacy communities, trust is really important. So having trusted organizations, I see like Ralphine with LISC Charlotte, who has trust with the west side of Charlotte and helps residents stay in their home, helps to figure out other economic development opportunities in the neighborhood, other ways to incentivize private development, other ways to keep residents there and keep them engaged and working in their local community. When you have trust with Anchor Institute, I see Patrick with Concord developing homes there, having trust with communities there, making a price point affordable for communities, hearing from residents, having them as a part of the decision-making process, building trust helps to establish a pathway for legacy residents to stay in place while you're also bringing in new residents into a neighborhood.
Let me go and see if we have any online questions.
The first is, historically, housing support's been based around the median income, such as the first-time home buyer credits. Would it be logical in the future to switch this to a housing support model versus looking at the median price of homes versus median income?
Yeah, could you reread the question? I'm not sure our panelists could hear it.
So the first-time home buyer credits generally are based on median income. So in the future, to provide better housing support, would it be more logical to switch to looking at median price of homes?
I see. Okay, make it based on the home price, not the income. I see
Well-
wheels turning.
Well, I will say it's like completely different, right? Because if you focus on income versus price, like price is going to be biased. I mean, it would depend how you design it, but it would be biased towards like, if it covers 2% of the initial house price, it's going to be biased towards higher markets. So it's going to be subsidizing effectively like already high price markets as opposed to an income based.
I would only add, and I'm not the homeownership expert, but I would also add that I think the reason a lot of subsidy and programmatic support focuses on incomes is because I think our public sector partners are very sensitive to wanting to make sure that they are not subsidizing families that don't need the subsidy, right? So they target households at 80% of the median income or less, or something of that nature. I think, but to the question, to the asker's point, there is a reality check. If we're providing subsidies and support for households at median income or less, or 80% of the median income and less, if they can't find a house to buy, you really haven't had an impact. So I think we do have to think about moving programs along such that we are actually helping people get into the market by dealing with the realities of the incomes that the families have, but also the practical supply of homes available to buy. And those programs we should challenge ourselves. Are they really aligned so that we can move the needle on first-time home buy?
I just want to add that the kind of idea of first-time home buyer, for example, traditionally we think about $150,000 is first-time like entry point. There is only in Charlotte to 2024, less than 2% of houses sold under $150,000. And the median house price in the Charlotte area 2024 is almost $500,000. So if you are providing a program that supports somebody who's buying a $500,000 home, I don't think it's politically almost impossible, right? So, and also, but all these programs need to realize that the house price has increased dramatically. The same amount of dollar will just not get you to the kind of traditional first time and entry point home.
Let's see if we have a second online question.
Yes. What is the potential that housing could increase by as the total stock as baby boomers downsize, retire, or pass? How would this largest generation new housing affecting new housing?
I'm not speaking on anybody passing away.
Well, let's focus on downsizing.
Okay,
So-
downsizing, let's go there.
So an interesting case is in Japan, where, they've had population shrinkage for, I think, decades. And you can see anecdotes of just housing that used to have people there, and now it's vacant. You can buy it real cheap. You can get it for like $1 if you want to live certain places. So obviously, as if population were to shrink, there's spare units around, and that's going to be lowering house prices.
Yeah, I'd expand on that. We certainly have communities in the state where population has been shrinking and housing's very affordable, but is the housing in the place where the jobs are, et cetera, right? So that you run into issues like that. Now, if you can do your job remotely, maybe it would work.
Some of the, I was just going to say, some of the data points too with this sort of great wealth transfer that will take place from generation to generation here, that there will be opportunities for folks to get into the marketplace. But, a couple of questions. One, are they going to be able to step into whatever they're inheriting? Do you have the financial literacy and education and other pieces in place to take on the asset? The second thing is that asset near their place of employment or other things that make it work for their life? The third consideration is, as people are inheriting these assets, do they choose to keep it and move it forward, or is it in a state that it may need some type of upfit or repair, and do they have the capital to do that? If not, do they have to make another decision with the asset? So there's a number of things to sort of untangle as people downgrade or transfer from one home to another, or transfer assets. But there's an opportunity to help think about how that happens, and many nonprofits across the district are in place to help families work through that. We actually, one last thing I'll say on that is that we do have quite a significant effort and partnership with the Atlanta Federal Reserve Bank around heirs property. And so it's a big topic of ours. We try to make sure that we're providing the data. We try to provide the information. We do convenings around heirs property and making sure that people understand, how to untangle. Sometimes you've got things that have just been tangled up for generations that could really be an asset for a family. But if you can't figure out how to get access to it, then it remains locked up. And so to address and improve supply and bring on some more market opportunities, unlocking some of those challenges could be an answer to some of this puzzle.
I just want to add, I think in most of the large metro area in this district, we are not seeing population decline at all. We are seeing population increasing, right? In Charlotte metro area, every day, about 125 people are moving to the metro area. So, that's just, there are probably other parts of, for example, the state or even the district, rural area, we are seeing that, but there is going to be a huge mismatch between where the opportunities are and where those like population declines or where the housing stocks are.
Let's bring it back in-house. I know we've had some hands up. I've got one right here, and then we'll come over here if we have time.
Thank you. I'm Braxton Winston. So Dr. Chi, you said something that I think we should all be concerned with, because you mentioned that there's a segment of the population of demand that the market just won't serve. Is that something that we're just going to accept, that the free market will not meet certain levels of demand? I think it's analogous. I think housing is analogous to shoes, right? We all need shoes to operate in this world. I don't care if you live in New York City, Charlotte, Houston, Greensboro, any small town, right? And so there are very expensive shoes, or you can get $5 shoes. But you're going to have to get shoes to go about this way. Demand for housing is constant, right? People need places to live, and people will be willing to do a lot. But the problem is not the demand for housing, but it's the people who build housing. So is that something that we're just going to have to accept, that the free market will not meet the demand, that will not supply the demand when it comes to housing? Does it operate outside of the methods of capitalism?
Just want to make sure I make So just want to make it clear that I'm not saying they're not willing to. It's just the math doesn't work.
The math doesn't work.
But doesn't the market figure it out? Like you can have Louis Vuittons or you can go to Walmart and get $10 shoes.
There are
So-
also many other things that, not just the market, there's also the regulation piece. For example, there are many parts of the world where they want to say you have to, if you want to build a single family house, it has to be this big. And then the cost will just be there. And even for multifamily, there's also lots of regulation. You cannot build, let's say, a 200 square feet cell that fits somebody in. That's very difficult because of regulation. And then otherwise, if you follow all those regulations, most of the cases, the math just doesn't work. That's what I'm saying, that there needs to be public-private partnership. Or on the regulation side, you have to be willing to compromise on some of those regulations, or relax those kind of regulations. So the public sector doesn't really have to provide capital. You can also provide relaxed regulation. That helps too.
I would agree. I think it is less about the market not being willing to and more about it not being economically feasible. So the cost of the 1,000 square foot unit is the cost of the 1,000 square foot unit. We do development. Our construction cost, the cost to deliver that unit is effectively the same as the market rate development company. On the margins, yes. They put fancy countertops and 2 pools and 5 game rooms, right? That costs something, right? The structured parking costs something. But even when you peel all of that back, there has to be either different capital coming to the table that doesn't, but real estate capital in this country expects a 15+% return, period. And so the market rate developers are building those units to satisfy the capital expectations of the people who are funding those developments. So something in the math problem has to change. Either philanthropy comes to the table or impact investors come to the table and they say, you know what, I'll take an 8% return. Now we got a different formula, right? The cost of that can come down. Or we think about modular or think about other ways to approach housing. Or do we all need to live in 1,000 square feet, to your point about size, right? But something in the formula has to change on average. I'm not saying there aren't exceptions where people just dig their heels in and say, I don't want to serve this market. But in general, the cost to build a unit or a house in our community is, I'm going to put a number on the table, $250,000, $300,000, period. Period. Unless something else changes, I can't undo that. Right now, if I can get approved for building permit to do something creative or different, then maybe I can get it down 10%, 20%. If that return number is lower, maybe we can bring it down another 10%, 20%. But we can talk about all those different levers, but we have to focus on the levers, and then that allows us to do more development at a lower cost. But fundamentally, we are facing kind of the same issues. The cost of the drywall is the cost of the drywall, right? So that's our reality.
We might have time for one more question. I promised over here on the right.
Thank you. First of all, I am so excited to have this topic going on. So I have a nonprofit, it's called Home Again Foundation. And I love Braxton's question. I kind of understand where he's coming from. My nonprofit's been around 7 years in June. I don't normally get up and speak like this, but I honestly have to tell you, we have the solution. We have a community in Uptown Charlotte. It's been there 4 years this past March. We have been told by the VA, 50% of our residents are veterans. We've been told by the VA that we have the most affordable rent in the whole United States. We've been on every TV station. I couldn't tell you how many times in the last 7 years, especially in the last 4 years. I get phone calls every day. One, The biggest phone call I get every day, if people call 211, they also get Home Again Foundation. But the biggest problem is for renters is when their lease comes up, it's going up for the $500 for the new lease. And these are people that are working, got really good jobs, but they also got two kids in daycare, 2 cars. And they just weren't expecting that $450,000, $500,000 or $500 rent increase. But I do want to tell you that Home Again Foundation does have the solution. We have 1-bedroom, 2-bedroom, and 3-bedroom cottages in Uptown Charlotte. We're getting ready to expand everywhere. I'm trying now to we're building home ownership down in Union County, but we're also looking at a 40-acre to build 500 units along with a general store on site, a daycare, doctors on site. I already have them lined up to be there at least 3 times a week, and a lot more. But I just want to give you a real quick idea of the rent.
Can I ask what your question is for the panel?
Oh, my question is, I would
We're
love.
almost out of time.
Okay, I know. My question is, I would love to share with you, anybody in this room after this, because we do have the solution. In the rent, our smallest 1-bedroom cottage, $480 a month, including utilities, including supportive services. 3-bedroom cottage, 2 bedrooms, 3 bedrooms, 2 baths is $1,195,
So
including utilities.
let me turn this into a question for our panel, because this is, I think there's an interesting piece to this. What about people in place and the cost of the housing where they are changes for one reason or another? Is there a policy solution for that, or is that just part of the churn in the housing market?
I think it really is dependent on the financing partners, right? First and foremost, there is a reality to cost increases. So the inflation that we all feel, the housing market also feels. For example, we don't pay a property manager or a maintenance technician today what we paid them 5 years ago. It costs us more to cut the grass. It costs us more to do all the things that you need to do to operate a community. So the cost increases and the cost escalations I would speak to multifamily, are very real. And I think as long as we're in an inflationary market community, if that is a reality that will continue. Having said that, I do think the constraints in particular around affordable housing, because we are financed in large part with partners like the City of Charlotte or partners like the North Carolina Housing Finance Agency, we are regulated in those sections of the market to say we can't be overly aggressive. In many cases, we have to justify what we're trying to do from a rent increase perspective. And we're also trying to preserve the ability for people to stay in their unit. So I think number one, what I'm saying is when inflation gets in check, then I think increased housing costs start to see some relief as well. But I will admit that on the market rate side, where there aren't those regulatory partners or public-private partnerships, there is the limit to what market rate developers and operators can do on housing costs is really supply and demand. They're going to raise the rent as long as somebody else is willing to pay the rent. Right? That is a fact. Right? But they're going to raise the price of eggs until we stop buying eggs.
So can we do this, Kevin, as we go into this last section? We're going to ask this of the panelists in just a second, but we've got a Slido here. Where do you think the housing market will be in a year? Hopefully we have it. And our panelists, you're going to have like a minute or two each to give your most salient outlook for the year, or maybe a little further out in the housing market. We up and running? Okay, people are participating. There's your potential answers. I always love it when the first answers come in. Makes it look like one answer's winning big time. Where do you?
The emojis.
Yeah. Emojis are more fun. Where do you think the housing market will be in the next year? So far, about the same. And then after that, getting worse. Not much for improvement or much improved at this point. We're above 70. We'll give this another minute or two. Well, actually, while that's playing out, we can leave that up there for now, Kevin. Let's start with Carrie in this end. You're a year from now, maybe a little bit longer. What's your most salient point about where the housing market might be? And you can be regional if you want to be.
Well, I mean, where the housing market will be is largely determined by so many factors that I would be, if I could tell you where the housing market would be, I wouldn't be sitting here. But I would, my instinct is to say and focus on what our mission is as a community development team, which is we're focused on what's happening with low and moderate income households. And so when I talk about low and moderate income households, right now, there is still tremendous challenge on their pocketbooks. And so when we think about that a year from now, I would hope, based on what we're seeing with hopefully more supply coming online, some of the wealth transfer, some of the education, some of the community partnerships, that the housing cost burden situation will look different than it will now. I cannot predict that, but a part of our role is to support economic mobility in communities and make sure we're providing research, data, doing the convening to help support what's happening and understand current community conditions.
I probably the same as the consensus there. So I don't see there will be a huge change in the year, 1 year or 2 years, but especially in Charlotte area. So house price growth will probably pick up again in 2 years time because of the significant kind of cutback in construction in like later 2023, 2024. And then there's not going to be a huge decrease in mortgage interest rate. Don't count on that. So don't wait. Like if you were trying to wait until mortgage interest rate hit 4% to buy a house, don't do that. It's not going to happen because although the Fed may cut interest rate, but there is the other thing, the huge thing that's we're probably going to have a even bigger government deficit that will push up the long-term interest rate for sure. So don't count on that. So, and also if you want to know any new information, we will be released the 2025 State of Charlotte Housing Report in November this year.
I'm trying to be positive, y'all. It's getting really difficult. From a community perspective, I think in many respects it'll be about the same, but if I'm honest, the answer I really want to say is getting worse. And I say that more, we are a developer of mixed income and affordable housing. While we are producing in 2025, nothing has stopped. We're moving forward. I'm asking my team to brace for it to be much more difficult to execute and deliver in the next 12 to 24 months. So what that means is if our production slows, then we are not having the impact in the community that we want to have because we can't deliver units as fast. We cannot fight through some of the challenges around needing an increased subsidy and all the things we need to do to make this work successful. If I'm going to say the glass is half full, the reality is we just have to push through. And there are things like the fact that fewer units are coming online in 24 and 25 that might give us some relief in things like construction costs, in if there is some interest rate relief, et cetera. But we need some of those levers to move in order to allow us to continue the production at historical levels. And so I do think the short term is more challenged. My hope is the long term is much better.
So economists are known for not being able to predict what's going to happen, but to tell you why something happened in the past. I'm going to take a stab and try to tell you what's going to happen. Okay. So actually in the back, I have like a formal statistical model that tries to forecast house prices based on month's supply of housing. And that month's supply measures, it's sort of the inverse of the sales rate. That's actually been high, which indicates relative weakness in house price growth. So in my estimates, I get about the same. There is one thing that's coming up though. So if you look at the yield curve today, it's really odd. First it's flat and then it dips at around the two-year frequency, and then it goes up really high to the 30-year. So the S&P, SEP that Matt showed earlier, it doesn't have that sort of feature. But if that yield curve sort of plays out, where we get an interest rate decline, then I think you're going to get a double whammy. So you're going to first get the decline in the treasury, but I also think the mortgage spread is going to collapse. That's the gap between the 30-year mortgage rate and the 10-year treasury. I have another economic brief that explains how that's related to the slope of the yield curve. So if that plays out, interest rates fall, I think mortgage interest rates will fall even more than that, and that will provide a kick to housing prices. And then, of course, tariffs could be inflationary, so that could provide another sort of boost to prices generally. So just in terms of a housing price forecast, I would bias it slightly up.
And both of Gray's pieces not only available in the back, but also on our website, richmondfed.org as well. Kevin, can you go back to the slides and I'll put as we wrap up here. I want to thank my panelists for joining us tonight. And yes, please join me in thanking them as well. We are glad to have you hang around a bit and network some more. I think the refreshments have been refreshed outside. So as you exit behind you, as you're facing out to the right, back to the pre-function area, be happy to chat for a little bit longer. And the slide that's just come up, this is the first of the year. Our next one will be in Baltimore. You're welcome to join them in person, but for a local crowd, there will be an online option that you could join for that one as well. And they're going to be discussing factors about the labor market and what's going on with labor force participation. This has been tremendous. It is great to have a group in the branch and have a chance to interact with friends and new faces and make new friends. Thank you all for coming, and we hope to see you at a future event here. We'll be adjourned for now. Thanks.